let me introduce my panel to sort of get us going. An old friend of this programme, even though we're second series, Paul Munn from Par Equity.
Morning.
Good to see you again, Paul. I think we're going to hear about some things you're up to and some of your investee companies as we go through the programme. Dan Summers, Managing Partner at Boundary Capital. Welcome, Dan.
Thank you.
We didn't see you for the first series, but good to have you for this one. Martin Fox, an old participant, not just the grey hairs as well, but Martin chairs the EIS Association Research and Marketing Committee, as well as running his own independent marketing business that advises in this space. And last but not least, I can't say that every issue I get that bit sort of fixed up. Gordon Pugh from Blackfinch. Welcome, Gordon. Good to see you.
Thank you.
Right, don't forget, this does qualify for CPD. So as we get through the programme, I'll give you a little email address that you can email at the end of the programme, and you'll find out how to get your sort of CPD certificate. So, I mean, Martin, we're going to have a little panel session for the next sort of 15, 16 minutes, guys. Sort of get us up to speed. Where are we? We're sort of 3/4 of the way through the year. We're at the beginning of the kind of new tax year in effect, aren't we?
We are. I mean, there were two changes, weren't there, that took place came out of the budget and out of the pension capital review. And those have been bedding in, I guess, since that happened. First of all, of course, there was the demise of capital preservation plans within the EIS. Now, if you look at that from a Treasury perspective, that I think that's quite right. It has to be, because the tax relief is there to compensate for risk. And if there's no risk, the Treasury get very unhappy about giving away the tax relief. So that was, I think, inevitable to happen. But what was exciting, I think, about the budget last time is that the only tax product that was enhanced in it, improved in it, was the EIS, with the introduction of enhanced amounts that can be put into knowledge-intensive businesses.
So for you, Paul, sort of part the removal of the capital preservation schemes didn't really have an effect, didn't it? It's not the way that you sort of operate.
No, I mean, when we began the business in 2008, we were always targeting that technology-led growth opportunity. So we've always been very in the risk business. And that seemed, as Martin said, was always our interpretation of where the EIS scheme was targeting. You know, it was to support investors who wanted to support those businesses. I mean, I think it's a very good thing for the industry. It certainly has helped us, and I think it's the whole emphasis that was put on it in the autumn statement actually raised the profile of EIS generally. So I think we've actually seen a lot more interest since that announcement.
And Dan, for you at sort of Boundary, as you looked at the changes earlier in the year, how did they sort of seem to you to sort of be playing out, for particularly from the advisor perspective?
Yeah, so kind of echo what's just heard, because we're also technology investors, so we've had a very similar experience. I think there's kind of two sides to this. The first one is that EIS has always had this element of having schemes, and I think that now that those doors are closed and closing, advisors kind of in two minds. There's a sort of slight sort of disconnect. On the one hand, they're sort of feeling, my God, how can we not have our cake and eat it anymore? This is really scary. EIS doesn't work for me. And then there's this kind of dawning, which is like, right, now the pen is dropping. This is actually fair risk for fair reward. And then they're sort of, again, coming to the realization that there are certain sectors where that is going to be fit more naturally.
And Martin, just going back to, I mean, with the capital preservation schemes, I mean, in a sense, the relatively easy piece of advice was to use a capital preservation product for a big chunk of clients. Has it, in a way, actually removing them from the landscape for the current tax year, just made it a little bit easier from the advisor perspective, because you've got to focus on the growth type businesses, the growth type investments?
Well, I think there's two implications. I mean, yes, it does, because you're channeled into your thinking. But what has been, I think, quite marked in coming out is the interest now coming from the clients. Several wealth managers have spoken to me about the fact they're now getting demand from their clients for EIS, and in some cases they're ahead of where their advisors are.
Yeah.
And so that's certainly changed the landscape. And the fact that it was highlighted so powerfully in the budget, with the government putting its weight behind and support behind it, I think has helped that as well.
And Gordon, from Blackfinch's perspective, how did you sort of view that sort of first part of the year, which had a degree of uncertainty, I think, for people who were kind of new to the sector?
Yes, certainly. Well, of course, uncertainty doesn't help anyone, and it's always better when we know what the playing field is. This year we've seen quite a few changes. with the advent of capital preservation going, we've seen a more level playing field, I think, for people, along with the growth EIS side. Further to that, with the education that we're all doing, going out there, seeing advisors, making sure they're well aware of the types of investments, what the risks are, and then putting those to the right clients can really make their planning a lot easier.
And on that education side, what are the kind of things that you as a firm have been commonly asked by people who are relatively new to the space?
Yeah, well, a lot of the time we're just trying to marry up the sort of case studies that's going on. EIS, we know all the tax relief, the income tax relief, the capital gains tax deferral, the main drivers for it. But there's a lot of practical applications for advisors in terms of planning, not just the investment side, where they're after being able to deliver a better service really for their clients.
And we'll come on and talk about inheritance tax, but in sort of particular later in the sort of show. I mean, Martin, from the association's perspective, kind of what have you been doing, particularly from a kind of an education perspective in the last sort of few months, and perhaps more importantly, what's coming up later in the year?
To extend it beyond a few months, we've introduced a series of guides on EIS, which have gone down very well.
Yeah.
One was called Under the Bonnet, looking at actually how it works.
Yeah.
More recently, managing risk and understanding risk. So, and they're available on the ESA website. But I think it's important that in a new risk landscape, advisors understand it and are competent in it. So that's important. But there's also the association's getting out. There's a whole series of roadshows each year now, going out around the regions, talking to advisors. We're linking up with Money Marketing. We're open to invitations.
Sorry, who? Money Marketing? Is that a magazine?
It's got a website as well, actually.
Okay.
Yeah, just so you know. But you get platforms like GrowthInvest putting on events.
Yeah.
And we're open to be invited by. PFS invites us to speak at events from time to time. So, and there's a new ESA website coming along in a couple of months' time, which will be far more educationally based.
Okay, lovely. Now, Gordon, this issue of sort of risk that Martin sort of touched on there, and Dan, pick up on this as well. I mean, this is I guess, one of the essential points, isn't it, for an advisor when they're sitting with a client, trying to kind of talk through the kind of the risks associated with an investment like this. How do you begin to sort of frame that in your discussions with the advisors? Because you've got a broad panel of companies, all you would generically call, I think, growth type businesses, but given the different sectors they're in and the different stages they're in, there's a different risk profile associated with each individual company.
I think there's a number of aspects to that. There's the risk that's inherent in each of the companies.
Yeah.
And I think one of the definitions I always liked about risk was it's doing things that you don't understand. So the key is for us is to find people and find investors, certainly from our angel syndicate, that have direct knowledge of either the technology or the market or the consumer or customer for that business.
Yeah.
And that gives everybody confidence that there's someone with that expertise that A, has looked at it, but probably actually more importantly is writing a check and investing in it themselves. So that there's that big endorsement and tick in the box from them. And if you do understand something, I think there is less risk. But I think the other thing we very much reinforce with anyone that's new to the space is this idea of diversification and portfolio effect. We get very nervous, and I think everyone gets nervous when people believe they're going to spot winners in the technology space. That's incredibly hard. And the way to manage that is to get involved, I think, in a spread of investments in a portfolio. And I think there's a lot of evidence, empirical evidence and studies that have taken place that show if you do that, the returns can be reasonably consistent and are attractive. And they're then enhanced by the tax benefits. But I mean, you need to be investing on the basis of this is a good investment, full stop.
Yeah.
The tax benefits are additive to that.
And down that point about spotting the winners, I guess particularly with technology, everybody wants to think, I'm going to find the next Google or Facebook, or in the case of UK terms, I think Skyscanner is a great example of a kind of UK business that has made a lot for its investors. But it's to sort of Gordon's point, it's kind of understanding. It'd be lovely to find a business that big, but in reality, you're just looking for good businesses that are going to grow in a steady way.
Yeah, so this is the thing that kind of getting across to people who want to invest in this space is that every time an experienced fund manager looks at a particularly a high-tech business, they are more likely to lose than to win. And that's kind of a weird soundbite, if you like, for why would you even get up in the morning to do something which you've got a greater than 50% chance of not winning. Now, I'm being a bit provocative here.
Sure.
We have a venture model which again is de-risking, I think similar to what we've heard is where we get people on the board with experience, and we can only invest when they do that and when they put their money where their mouth is alongside us. But ultimately, it's really just explaining the nature of the risk, both qualitative and quantitative. The thing which I do feel for advisors in this space is the lack of real data. People seem to be very shy about failures in this business, and I would always say to advisors, ask. Don't just take the lovely stories of the sky scanners, because every sky scanner, there's 100 not sky scanners, and there's 50 kind of good ones, and there's 10 pretty good ones, etc., etc. And I think I just echo the point earlier. It's really about not being heroes. It's just about having solid experience and a good process all round. There's always going to be rolls of the dice, and those rolls of the dice are the only way you can deal with that is, as we've heard, diversification. But just make sure that people are experienced and don't believe the hero stories. Yeah.
And I guess, I know it's a point that Paul made very well in the last series. If you look at portfolios that you guys both run and were to perhaps compare them to an open-ended investment fund in the UK equity market, that open-ended fund manager, if he or she's honest, is going to have some failures in there. Hopefully don't lose money in the way that you would hope not to lose money, but it's an investment at the end of the day. So capital is at risk, so a loss has to be expected, I guess.
I think this is a very, very valid point that people need to probably wake up to, is all of the capital preservations, safe investments, they haven't all been safe. And that comes back to the kind of schemy thing, which I think thankfully we've moved away from, and now into a more transparent environment of the right investments going forward. But also, if you look at the high street, people thought investing in bricks and mortar, investing in retail was safe. Investing in blue chips was safe. I'm sure we're going to talk about economic uncertainty, but big businesses have been built in really uncertain times, because a disruptive business is exactly what it says on the tin. It doesn't need a good or a bad economic climate, whereas everyone else needs a good economic climate. So I'm not saying that you should take more risk than necessary, or that high tech, high growth, high risk is the way forward. That's clearly not the message I'm trying to give. It's really just that actually some sectors come under disproportionate scrutiny for risk because they sound risky. And what we see is a lack of a balanced approach to risk and transparency and a sort of data across the board. It tends to be, in our view, more emotional than rational, and it comes back to diversification at the end of the day.
And I guess that issue of diversification would be one that you would echo as well.
Yeah, certainly. If we're looking at EIS portfolios these days, it's most likely over the tax year any provider would probably have around about 10 investments, hopefully, within their portfolio. Now, of course, we would always like to just receive all the money ourselves as a fund manager. That would be great. But quite honestly, if it's my money, my parents' money, etc., it would be diversified across ourselves as well as a few other fund managers. And if you are achieving 10 companies within a particular fund manager, 3 different providers, you've got your 30 companies. That then pretty much mitigates single company risk. And the actual possibility of overall failure reduces to infinitesimal small amounts, which is only a good thing.
And Gordon, picking up on that, if an advisor was to use, say, all 3 of you for a spread of clients' money, the likelihood of the underlying client being investing in the same company across the 3 of you, I'm guessing is quite small.
Yes, I think it's very, very minute, and I think that's because there are themes. There are also regional sort of biases, but I think that the chances of that are very small.
Because it just kind of strikes me as I'm asking the question that if I've got 2 UK equity portfolios in an open-ended sense, there's a fair chance I'm going to end up, owning some of the same large cap type stocks. So I'm kind of more exposed than I kind of know. Martin.
Can I just say that what you might look out for is when it comes to second round or third round funding.
Sure.
Because then you might get more than one company in the market coming in to support a company that's clearly successful and looking for growth. So you might get it happen there.
Yeah.
Let's pick up on the issue of advanced assurance. So this is kind of what qualifies and doesn't sort of qualify for the sort of tax relief. It's one of the issues that advisors do need to be aware about, don't they, Martin?
Quite honestly, just about every company in a fund, or all the company in a fund, will go for advanced assurance first.
Yes.
And the manager will put it forward for that. And that just gives the reassurance that as far as the revenue is concerned, HMRC, they're going to give the tax relief on that if nothing else changes. And so that's important. But again, it is showing the right amount of risk. And they've looked at that doubly hard, I guess, over the last few months. And if it's not there, they've been rejecting more cases. But the advantage of what's come out of it is that their whole process has sped up enormously. And so it was going on for 3, 4, 5 months. It's now that many weeks. And so it's far more responsive.
And Gordon, how easy or hard is
this? That would be.
Sorry. Gordon, I do apologise. Paul, what? Oh, I've lost the question now. Of course I haven't. Paul, how hard in reality is it to get that assurance from HMRC?
I think Martin's right to say it's sped up, and I think there is a bit more clarity around it. But I think the really honest answer is that there's still some uncertainty in the process.
Yeah.
And in fact, what we've been doing in cases where we feel there's any questions is actually getting proper authorisation in advance rather than the assurance. So you can submit the documents in full, in final form, and get a definitive answer. And that gives everybody, particularly the fund manager and the investor, absolute clarity around it.
And Dan, I'll get your name right. In fact, we don't have any Gordons on the panel today. So, but to that sort of point, for the advisor who's other than you, it's all going so well. Thank you. No CPD for me at the end of this. Dan, more importantly, from an advisor's perspective, not new to it, and you're looking for a bit of risk. You need to know some of these questions, don't you? The answers to these questions about advanced assurance. To Paul's point there, because you don't want your client to be exposed to a situation sort of end of tax year, early new tax year, where it hasn't quite come through.
Absolutely. So you just kind of need to know the full picture, and you just need to be talking to people and get your fund manager just to be really open about things and be open with your clients. There are risks all over the place, and I like this point about things you don't understand. We don't understand everything that goes on in HMRC, for example. And actually, on a serious point, if we're doing it, we have an SEIS and an EIS fund. With SEIS, they tend to be more straightforward from that point of view. They're not straightforward in other points of view, but they're straightforward from the point of view there's just less heritage, less baggage. Some of the EIS ones, you can get into some really complex situations, and if we're doing a blend of SEIS and EIS, which is quite common, because 150k for an early stage company doesn't really make any sense actually on its own. It was just a number, so 300 might be, whatever it is. And that has some quirks, and there's been some changes there in recent times. So I think advisors do sort of need to know this, because there is even an EIS risk or an SEIS risk here. Even with a competent manager doing the right amount of due diligence, the circumstances of the business might change for the better. The 3-year cycle may not happen, and it's happened to us where we had a good news story in terms of the underlying investment, but a bad news story from a tax point of view. And it was like, can the tax tail wag the exit dog here? Which it didn't, but clearly there were a lot of people going, but this doesn't happen, this isn't meant to happen, and it's kind of like, yeah, I get that, but this is the situation. And so, the more that your advisors kind of really know what goes on in your business, and vice versa, the more comfortable they can advise their clients of the full risks. And actually, when you look at the big picture, it comes down to the fact that some things will go wrong, but overall, these things balance out and the rewards should justify it.
Okay, lovely.